Good morning and welcome to Money Matters. I'm David Crowell from Mortgage Network, and this is Emily Johnson from Polaris Capital. We're going to kick off today with Emily telling us what's happening in the markets. Today is June 16th, Friday, June 16th. So Emily, take it away. Tell us what's going on.
Markets have been rather lackluster, actually. We saw an increase in rates from the Fed earlier this week and a little bit of a downdraft from that, but it was already priced in, so that it really didn't move things too much. We've actually seen a big negative dive in the NASDAQ, interestingly, since last week. It sort of has rallied back somewhat, but the NASDAQ, the FANG stocks, definitely took a little bit of a nosedive and have started to rally. But really, other than that, we've just sort of seen just continued sideways movement and some intraday volatility that seems to abate by the end of the day, and that's really it. So we're really not making a whole lot of changes to our allocations right now because unless there's tax issues, we're really seeing that these strong equity allocations, even the bond allocations, are continuing to move up. So that's kind of been the ongoing theme. We keep waiting for something to happen, and yet we're still sort of seeing the same trudging along. And there's making sure that we're making sure that all of our cash is invested, though. That's right, the point.
Right. There's talk. There's always talk. There's talk here, talk there. 11 times in the last 14 times that there's been a run-up in interest rates. It's been followed by a major adjustment. If not a recession, then a major adjustment. It rarely is seen coming because a gradual rise in interest rates usually echoes an improvement in the economy. Mm-hmm. Are you starting to hear worried talk?
Sure. I mean, that's sort of the rumblings have been there that if interest rates go up, that we'll see certain corporations' debt become more expensive, and that could cause for revaluation of a lot of the equities that would impact. But really, you're not seeing that happen much. You're seeing it some in retail. Obviously, retail's been hammered, especially retail that doesn't own their own buildings, and some actually that still do, that are more on the real estate side than in the retail side. But retail in general has just been getting pummeled. You're seeing some revaluation, I guess, in the small caps because they would be impacted more than the larger cap companies with the big, strong balance sheets. But really, that rumbling has been around for probably 6 to 12 months, but seeing it actually take hold, that's definitely had a little bit of an impact in the tech sector. But again, that rumbling has been continuous, and by and large, the concern that there's inflation is really not there. So yes, interest rates are going up, but they're already priced in. It's priced into most companies' debt already, and we're not seeing a whole lot of actual inflation or growth to support that happening at a faster rate.
That's very interesting. Emily just touched on 2 points. Interest rates aren't just interest rates. They are short-term interest rates, mid-term interest rates, long-term interest rates. So interest rates are quantitatively and qualitatively very different from one another. What Emily just touched on is that the CPI, the inflation rate, has remained stubbornly low. This last week, CPI came out once again below the Fed target. Came out at, I believe, 1.7 or 1.8%. Stubbornly below the Fed target.
Of 2.
Of 2. That's the projected, the Fed's inflation rate, projected inflation rate being better than 2. And the Fed, therefore, has less and less justification for its rises in rates. So there's starting to be some questioning, some backlash whether Janet, I think. Janet. Whether Janet Yellen is really the one to be leading the Fed, and why is it that the economy is not growing quicker? Everybody's kind of starting to look for a reason or a scapegoat as to why the economy isn't growing faster.
Well, there has been very little incentive. I mean, I think that was sort of the plan, was that there was going to be additional tax incentives, there was going to be infrastructure, all of these things were supposed to be coming down the pike, which is a lot of the reason that the markets ran up when they did, and even part of the reason why interest rates started to bump up when they did, and that's just not, it's really not coming to fruition. We're spending more time looking at tax returns of the president and of his son-in-law than we are actually moving forward.
We actually haven't looked at the tax returns of the president or his son-in-law. We have talked about looking at the tax returns.
Even better. That means we can talk and talk and talk even more about it and still do nothing. It'll be great. So, which means that we'll just continue to sit in this little sideways trend and wait to see when incentives actually come along. And that is the case. I mean,
that is the case.
The expected incentives are not coming along. They're just not.
That's correct. And
there's no other drivers in technology that are changing or just disturbing the normal course of order. So there's nothing else, barring any incentives or stimulus. There's just nothing to drive it right now.
And melded into that same issue is the really gnarly one, the really difficult one, which is when growth occurs, and if growth occurs, where do the quality jobs come from? The jobs that allow consumers to buy houses and to have real lives and so forth. There's a very, very big chunk of the nation right now whose wages are stagnant and have been stagnant over well, depending on the economists that you look at, stagnant over a period of close to 20 years. In other cases, stagnant over a period of at least the last 10 years. So this wage stagnation in the lower half of the economy is a big problem. And it's everybody's, right, left, Republican, Democrat, everybody's focus is on job creation with an asterisk, meaning high quality job creation. And that's the tough one. That's the real tough one confronting the economy. And we just don't know where those are going to come from. The growth areas, well,
everything, and of course everything's local because if we look at our area, we are seeing a lot of growth. We're seeing a lot of money being spent here, both in real estate, from tourism. So, everything being, if we take it down to our level here, we're definitely seeing a lot of good health. People's home values are going up. Definitely the island's busy. The whole area is busy. There's construction left, right, and sideways. So, and
the entire service sector is short on workers. So there's in Hilton Head Bluffton, there is effectively 100% employment. There are more jobs than there are people to fill the jobs. Well,
but that said, I still get the same question, when new clients walk in the door and existing clients of, where's my income going to come from? Because that pendulum is still so far to the side that is hurting savers at the extremely low interest rates, that trying to find good and healthy yield without a whole lot of risk is very difficult. I got one email this week that was fantastic. It said, I need somewhere to put some cash for a short period of time with a very high yield, but with no risk. I love questions like that. I'm looking for that too. Just know I'm looking for that too.
I also am looking, so could you put me on the list?
We're all looking for that.
Yeah,
so it's there somewhere.
Yeah.
And if you find it, make sure that you do look behind the curtains. So anyway, we'll be back in just a minute. We've got a little bit more to discuss on our local economy, and then we wanted to talk a little bit more about financial planning and mortgages in general. So please stick with us. We'll be right back.